Hello and welcome to another episode of Bidishanomics. I am Savika Sayyad and with us Dr. Bidisha Bhattacharya, our consulting editor for economics, who takes your question, dear members, on India's economy, how global affairs are impacting us, how we're looking inwards. Bidisha, quite a few questions, very detailed ones, always keeping us sharp. The first question is by Saito. They're asking, in the context of that Punjab economics column you had written, should there be a government body for all states which specifically monitors fiscal health parameters and ensures short-term debt-fueled consumption is not done and long-term investments are done so that bad decision-making is acknowledged?
Interesting question, and thank you for going through the piece and for your kind words. Let's first understand where we stand with Punjab right now. Okay, so Punjab, specifically, Punjab's fiscal deficit is running at 4.1% of the state's income right now, and specifically, the Finance Commission's recommendation was 3% of the limit. However, Punjab is standing at 4.1. Now, that is a risky state to be in, and Punjab's debt is 45% to the state's GSDP, the gross state domestic product, now, which is the highest of any major state. Now, the natural question would be that why wasn't anybody monitoring this? And if somebody was monitoring this, why didn't they signal anything? Now, to answer or the fact that you mentioned, is there a government body that monitors government finances or how government is borrowing? There is a short answer to this and also a long story to this, I would say. It has a name. It's called the Fiscal Council. Now, think of it as a referee for the government spending. A small team, an independent body that looks into how every state finances or budget or government, the kind of borrowing that it is doing, whether that borrowing or that money is going into growing the economy further, or is it just being used to keep the lights on? Which means, looking at the revenue expenditure bit, the capital expenditure bit, whether the borrowing that every state is going ahead with, asking for more money from the center, whether it is justified or not. Now, before I go into the story, there are economies that have such fiscal councils. Britain has it, United States have it, Ireland also has it, Australia has it. Roughly 50 economies in the world have it. Now, India came remarkably close to building something like this back in 2017. The government of India had specifically reached out to a senior economist, Mr. N.K. Singh, who was a former Rajya Sabha member, to lead a formal review of India's borrowing patterns, or the state's borrowing patterns, or rules rather. His committee, which is the FRBM committee, did not just float an idea, but they published a report. They produced a report, which was a 4-volume long report, a detailed one, titled Responsible Growth, a Debt and Fiscal Framework for 21st Century India. And inside that report was a very clear cut, ready to legislate design as to how to go about this fiscal council. Now, here's what the design actually looked like. The first point was scrape all kind of old laws, old borrowing law that you have, and replace it with a newer one. The second was build the council with just 3 people, 1 chairman and 2 members, and none of them would be serving exactly at that point in time in the government, and there will be a 4-year term for every member or the chairperson in that council, which cannot be renewed. Why so? Because that council will be appointed by the government, but also ensuring that it is protected from the government, that they are making neutral decisions. They are not making decisions that would sort of rely on them trying to please that political party or that government who is in power at that point in time, so that their sort of designation can be renewed once again in the fiscal council. The third thing that that report explicitly stated was that give this council real work to do, which means forecast government finances year on ahead. And for the center and every state together, the council was also, the recommendation was such that check for the finances, check for the pattern so far, the trend so far, be the body that decides whether a government has a genuine excuse to borrow further money or not. or is it just overspending? And most importantly, the government or the committee, the FRBM committee or that report did not just stop at the center. They also spoke about how states could go about building sort of a council and explicitly sort of monitoring their spending, whether most of their expenditure is going into just paying for salaries, pensions, or the interest payments, the money that doesn't generate more money out of it, or is there a good percentage of it that goes into capital expenditure? Now, this wasn't just a Delhi only fix, this was for every single state. Now, what happened? Why couldn't this be implemented? This was, and before I get into that, in fact, after a few years, Mr. N.K. Singh became the chairman of the 15th Finance Commission, and he did not. I mean, back then, when he spoke in the report in the committee about this idea, again as a chairman of the 15th Finance Commission, he had again reiterated this idea. However, there were reports at that time that the finance ministry itself pushed back, because it came across such that if there is going to be scrutiny on the finances of the states, there's going to be scrutiny on Delhi's spending pattern as well. So this is something that the finance ministry kind of pushed back against. And the one body, to think of it like that, if right now we would have a fiscal council in place, probably predicting this kind of a debt to GSDP ratio or debt to GSDP percentage of 45 to 46, 47%. I mean, if you go through the piece, you have certainly gone through the piece. I would urge all watching this episode to go through the piece, because you'll be able to see the graphs and the charts that we've prepared, where you can see how dire the situation is in Punjab at this present moment. So what do we actually have right now instead? We have something that, the states kind of create their own report and kind of correct their own homework. That's kind of the situation at this present moment. Now, the Finance Commission has definitely come with a 3% limit of the fiscal deficit target, which Punjab has already breached. There are other states as well that have breached it. Then comes, and why so? Because the Finance Commission checks that target only once in 5 years. Then coming to RBI publishes a very good database of the state finances, but it cannot enforce upon any particular state to follow those particular targets. It's there out there, handbook of statistics by the state finances, RBI state finances. Then we have the government's auditor checks. The government's auditor, they check the books, but that is only after the money has already been spent. So now here comes something very interesting, which is the political angle of this, because usually there's a rule that says that if you owe the center money, you need the center's permission before you borrow even further. Now that sounds justified, but not when the person or the institution or the government that you're borrowing from might also be your political rival.
Right.
So, and this is not just theory. This is happening in real time. The Kerala government has sort of taken the central government to the Supreme Court, saying that their borrowing limits have cut down for no reason. There is no proper reasoning for it as to why their borrowing limits have been reduced, despite other states also incurring high debt or debt percentage, probably more than them for that matter. So this is something where it can get a little risky. Definitely, instead of, there have been recently certain economic research groups that have come up with a solution that no need to wait for what New Delhi decides anymore or what the center decides anymore. The states should come up with a watchdog for themselves and report to the state's own assembly and start evaluating their finances. Of course, then the behavioral economics factor comes into the picture as to whether the states would want to be monitored when it comes to finances. Because especially when it comes to elections or periods of elections, we have increasingly been seeing it. I mean, be it Tamil Nadu or the other state elections as well. Specifically in case of Tamil Nadu, a lot of freebies or welfare transfers, quote unquote, that goes under welfare transfers, that becomes a part of the revenue expenditure. So automatically, again, the part of the expenditure or the part of the government finances that bears the brunt is the capital expenditure. and they sort of start building less but spending more. And they're spending more on things that do not generate more money. So yeah, that would be sort of a solution, but definitely a fiscal council should be in place. Has the government not thought about it? Definitely they have thought about it. That's the story that I narrated to you. In 2017 it had started, and hopefully we will have something in place in the future.
Right. Vidisha, the next question is by Anubhav Saxena. He is asking, Indian economy is at some inflection point. We are highly integrated with world economy, but very domestic market dependent as well. Neither rich nor LDC too. What can India learn from rise and downfall of the Japanese economy, and what can China teach us too?
Interesting question, and I'll go country by country. You've mentioned two countries, both very interesting stories. Specifically, first, let's talk about where India actually sits. So, the World Bank recently confirmed in a report this week itself, this month rather, that India remains a low middle income country, and it has been maintaining that position since 2009, somewhere in between. And you're right about the dual nature as well. Approximately, India trades in goods and services for 46% of its GDP, but domestically, households consume about 55 to 60% of the entire economy. So, India leans on the world without completely depending on it. Now, let's come to Japan, the first country that you mentioned. So, the post war story is quite well known. Cheaper exports, extremely high savings. The yen was at an all time low. Until the 1985, when a deal came into place, which was the Plaza Accord, which led to forcefully increase the value of the yen. Now, the minute we have already, discussed about this in the earlier episodes as well, the minute you increase the value of a particular currency in an economy increases, the exports become less attractive. And if your currency depreciates or the value reduces, because then you become, then you can sell cheaper exports to the rest of the world, right? So then your exports become more attractive. Now, in this case, what happened is when the yen was kind of forcefully, its value was being increased, in order to cushion exporters, the government basically flooded money, cheap money, into the economy of Japan, which they technically thought would help with investment, but that money completely flowed into land and stocks. So, what happened can be best explained by a concept by an economist, Richard Koo, whose idea of balance sheet recession comes to mind in this particular context. Is that, he said, picture every company in the country that suddenly starts owing more than owning. So it's constantly borrowing more than it owns, and at the same time, it's earning money. Okay. That was the situation or the loop that Japan got stuck into. Now, normally cutting interest rates to zero or even negative rates was something that Japan tried. Then in the 90s or later in the 90s, we all know about that, negative interest rates that Japan had gone to. But that did not help the economy at all, because all the money that was kind of being borrowed or utilized was only utilized in paying for the debt that already those companies owe. No new kind of capital building, infrastructure building, or investment was taking place, and as a result, the economy stalled. And nothing new was kind of coming up. And if the economy stalls, there'll be no more production, the infrastructure won't expand. So, of course, everything kind of stagnates. Unemployment keeps rising. You can't hire more people, you can't expand factories. So no matter how cheap money gets, so that gave Japan the lost decade that we talk about. And in my opinion, it was not just one lost decade, it was lost decades. It went on for 20 to 30 years. But here is where the textbook story stops. What proceeds from here, or what's happening in Japan right now, is something that I have written about a couple of weeks back on Japan, to be specific, that Japan is doing everything wrong, but it's working out. So here, in today, standing today in 2026, the IMF's latest review found that labor shortages in Japan are at its highest. The wages are increasing, or wage rates are increasing in multi-decade highs. At the same time, unemployment is around 2.5%. Now, there is a very simple concept in macroeconomics that we had studied called the Phillips curve. It basically looks like this, which states that if unemployment is low, then inflation will rise.
Okay.
That's the basic logic. If inflation falls, then unemployment should rise. So now this particular situation, going by the textbook Phillips curve, what's happening right now in Japan is going completely against this Phillips curve logic, because inflation is also under control under Bank of Japan's 3% target. So now what is exactly happening? There are three specific things that are happening right now. Japan has been, at the same time, by the way, increasing its interest rate from this near zero policy, which it has been holding since 20 to 30 years, for that matter. Now it's adapting to a shrinking aging force. It has increased that there is very high or increasing of female labor force participation into the economy. There is also longer working span that has increased. Earlier, people would retire earlier in Japan. That's not happening. And at the same time, they have heavily invested in automation and also building global value chains around automation with other countries, including India. India and Japan, in fact, we are talking so much about free trade agreements, India, EU, India, UK, India, US trade deal also. There's one that has gotten the farmers to come out of their homes right now as well, and protesting. That's something that we'll get back to in the near future. But specifically, when we're talking about FTAs, India, Japan go a long way back.
Okay.
In 2010 to 2011 was when India and Japan had signed an FTA. And that led to, the Maruti Suzuki, specifically Maruti Suzuki, where Japan kind of built very strong global value chains and supply chains with India.
Okay.
And through that automation, also Japan has very high income surplus with the rest of the countries. To be specific, the data that I have here, the income surplus is from nearly $3.7 trillion in overseas assets. So the lesson to learn from Japan is not to avoid real asset bubbles, I would say. So the real lesson to learn from Japan is not to avoid, real asset bubbles. That is something that, multiple countries have suffered from, and multiple countries we can learn from. There's also the dot-com bubble burst. But specifically, the real lesson to learn from Japan is how to grow old gracefully, in my opinion. How to get accustomed to an aging workforce. How to specifically, be it from an institutional point of view, be it from a labor markets point of view, because it is estimated, there are a couple of reports, that we will also reach that peak by the early to mid of 2040s.
Okay.
But by then, our labor infrastructure, our human capital, our institutional infrastructure should be built in a way that we can reach this comfortable space that Japan is in right now. Then coming to China. Now, China has a very interesting story. We all hear about, the real lesson for India to learn from China might be manufacturing or the property crash bit. But there is something that I'm so glad, Anubhav, you mentioned these two countries, because these two countries are specifically two countries that ThePrint has focused on. We have Japan, and then now coming to China. Now, in case of China, I've recently come across this OECD subsidy report. There's a database that OECD has taken of 525 top global manufacturers and their growth from 2005 to 2024. So here, the data that we found out specifically on industrial subsidies is that Chinese firms receive 3 to 8 times more support than their counterparts elsewhere. Now, the result of this, or the consequence of this, is quite striking. So for Chinese firms, I'll just give a small short percentage, the number that matters the most. So now here's the number that's quite scary and at the same time quite striking from a competition point of view, that out of all the global market share that is gained by growing firms over that period from 2004 to 2024, 22% 72% on average came from subsidies rather than genuine efficiency or productivity. Now, what do I mean by industrial subsidies? When a state heavily subsidizes a particular sector, that means that sector or that country can sell that commodity at much lower price compared to other countries, and then they kind of captured that market. And that is exactly what has happened with solar panels. Before I get to that, I'll just say, see, 22% market share is from the subsidies of every other country, right? For Chinese firms specifically, that figure stands at 60%, 60%. So now that is the state-backed money when it comes to industries. Now, what does that do? There is a particular concept that OECD has mentioned in their report, which China has been doing, called BMBs, or below market borrowings. That is that the loan given at an interest rate that doesn't reflect the real risk of a loss that an industry might be going through. Let's say a loss-making steel maker and a very strong industry, but the state kind of gives a loan to both of these industries at the same rate. And the hidden subsidy is the hidden cost. The hidden cost, I would say, or the gap, is the subsidy that the state is paying. Now, in this particular instance, what has happened has specifically is very, very visible with the solar panel industry. Now, solar panels in 2005, countries like US, countries like Germany, Japan made up about 80% of the world's solar panels. Today, that percentage has fallen below 10%. The entire market has been captured by China because they kind of could sell or export solar panels at a much subsidized rate because of the industrial subsidies. So what can be the lesson that India can learn from China at this particular instance is what not to do. Okay. So the lesson is, because this opacity when it comes to subsidies, or not showing the entire picture, concealing that data, is not something that in the long run will kind of make you a superpower. All that it will do is sort of provoke or compel other countries to diversify away from that particular economy, which is trying to become a superpower at everything, especially when it comes to subsidies, because we do have an initiative in this area. We have the production linked incentives. But in that case, India should push for a transparent subsidy, putting the data out there, and then kind of moving into this global competitive picture instead of holding back the data, because you will not be any which way able to compete with China on those terms. Now, here also, I would like to talk about another big risk that India or the Indian government should heavily focus on, which is fertilizer. We are heavily import dependent on fertilizers as well. Recently, at ThePrint, we've had a very interesting conversation with Professor Ashok Gulati, where we've spoken about fertilizer import dependency. Now, what's happening there as well? China and Russia backed, there are certain firms, they are also providing a lot of industrial subsidies so that they can sell these fertilizers to the rest of the world, artificially cheap fertilizers, and that can actually make India even more fertilizer import dependent, or increase the import dependency of fertilizer. So this is something, it's about time that India kind of pushes to reduce this opacity of subsidy data. Increase that transparency, be it from a manufacturing point of view, be it from a services point of view, any sector for that matter, because all of them are kind of intertwined and they'll impact you in some way or the other. So that would be my response.
Now, Bidisha, the next question by Narendra Arya is also referring to India's relationship with unemployment right now. They're saying that studying unemployment is an important subject in economics, of course, and India's population, especially, like most countries, has different grades of, skill, or maybe education or employability. But the blame for the high rate of unemployment falls on the government. He's asking, how do we segregate this lot and count them as unemployable so that they can go for further studies or skill development? Because we should be aware of the fact that merely being a graduate is not a guarantee to get a job. The employer who is paying must be looking for some talent.
Very important question. Now, it's important to understand how in economics we look at unemployment and how is the unemployment data collected in the Indian economy. are very two different stories altogether. Okay, so in economics 101 we are taught or to look at unemployment not from one particular lens. There are specifically three lenses. The first being frictional unemployment, which is sometimes we've all been through that phase that we are between jobs, we're just exploring opportunities, which is temporary, which is kind of you're probably trying to upgrade your work profile. Now that's called frictional unemployment. That's temporary. That's normal. I mean, that's not something that's scary. Then comes cyclical unemployment. Now this is where the whole economy kind of slows down, and the companies in general, because of some new innovation, or let's say right now AI, the companies stop hiring or reduce hiring all over the world. Then comes something that I believe your question pertains to the most, which is the structural unemployment. Now, structural unemployment is that there might be enough graduates out there, but there aren't the right kind of skills that the employers are looking for, or there might be not enough kind of jobs that are generated for the kind of graduates that we are producing in the economy. It can be two-way. This is the structural unemployment problem, and this is a long term problem. This is where a committee needs to sit and figure out exactly what's going wrong and what needs to be done.
Right.
Now here, this is the economics angle of how do we look at the unemployment data. Now coming to how does India calculate its unemployment rate or collect the unemployment data. First, there's a survey or a study done by the Periodic Labor Force Survey. This is known as the PLFS data that we usually refer to. There's also an ILO data, International Labour Organization, but specifically the PLFS data is something that we look at in India when it comes to understanding the unemployment angle or the sectors in which the unemployment rate might be increasing. So that follows a very simple international standard, just like ILO. It basically asks that if you are without work, if you are actively looking, if you are available to start, it does not really segregate or categorize, or rather it does not, PLFS never asks you whether your degree is authentic enough, whether your degree is sophisticated enough, whether it is really suitable for a higher earning job. This is not what PLFS asks, and honestly, to be able to do that kind of survey, it's not even feasible for the government with this scale and this population to be able to go into every single degree and find out whether how many of them. We do have surveys, we do have reports that come out as to which university is probably giving out fake degrees and all. But so asking the government surveyors whether to verify whether every single degree quote unquote counts or not, now this is something that gets very not feasible rather, and also very politically kind of risky. So here, now the question, or there was a part in your question that you're kind of asking for if a measure of that kind exists or not, and you'll find there are data that you might find genuinely satisfying. There's already some other measure, a different measure that runs alongside this unemployment measure. Now this is the India Skills Report. Now this is built every year, and this builds something called or this is built out of something called the Global Employability Test. This is where industries come into the picture, and they give kind of a percentage after the survey that they do, that in every single sector, it can be computer, software, or IT to be specific, what is the percentage of employability and what is the percentage of non-employability. And there is data regarding this. There is a 2026 edition for this, which puts employability at 56.35%. That means by industry's own judgment, a little over 4 in 10 Indian graduates are not employable. So here, it's important to understand this data for us to get into the next picture of supply and how much is the Indian economy or the company or the industries are being able to provide the kind of jobs that the graduates demand at this point in India. Now coming to, if the report has also broken it down field by field, as I mentioned. So for computer science and IT graduates, the score is around 78 to 80% that report considers employable, while ITI and Polytechnic graduates score as low as 33 to 46%. So your instinct is not just reasonable, there is proper data and statistic to it. Then coming to the two very different and sort of widely gapped numbers. The overall unemployment rate that we talk about is around 3.1%, but then there's also an 11 to 13%. Now, what is this gap? Let's address it. Now, first, the 3.1% is India's overall unemployment rate. Now, this blended together, it comes with workers who are probably informal workers, or workers who have not gone through even primary education for that matter, or high school education, or not completed their graduation, all of them in one number. Now, this is the 3.1%. When we move to the 11.13%, that is highlighted much more extensively than this 3.1%. This isn't the separate splice, and this kind of only caters to the graduates, to be specific. Now, this unemployment, basically people who hold a degree. Now, why is this gap so wide in the first place, and why is this gap so wide in India? It's important to address this. Now, a person with no education almost never shows up in the calculation or as a part of this PLFS data in itself. Now, that is not because they are doing well, but because they have no other option but to work, because they are not looking to get into the education enrollment, or progress further with their higher education or higher secondary for that skill development. So what they do is they enter into that informal workspace for very low pay. There is exploitation also involved in it. Farm labor, daily wage work, basically informal jobs. Now, this data does not get factored into the 3.1% either. 11 to 13% to bahut dur ki baat hai. Here, the problem that we see is not really unemployment, it's underemployment. This typical informal workforce. Now, a graduate, on the other hand, here something, there's a paradox that is into play here, which is very very funny, I would say, rather. So a graduate here usually holding a specific kind of job, matching their degree, then firstly there might not be simply enough jobs matching their requirement, or the kind of education that they've sort of done, or the skills that they've acquired, and the kind of jobs that they're looking for. Then comes something that has been recently come across in a couple of reports, that among the individuals between 20 to 29, we are seeing that whoever are employed or unemployed rather, 67% are graduates or higher. And economists have started calling this the educated unemployment paradox. So for any economy, over time, as you move from this developing to developed phase, or into the emerging phase, of course the number of graduates that you're producing, or the degrees, or the kind of degrees that you're producing, are probably increasing, but there aren't enough jobs to be able to match those degrees. And hence, as your educational qualifications increase, your unemployment in the economy might also keep increasing if you don't have the right kind of job. So this is a paradox. And but however, from the graduate specific number in India, there has been some interesting news. It has been improving, it has not been worsening. To be specific, 13.4% was the number in 2022-23, which kind of fell to 13% the year after, and now down to 11.2%. So now here I would like to genuinely separate two kinds that you've spoken about. You've spoken about one problem, that degrees that are kind of earned through dubious means. By dubious means, I would specifically refer to cheating, or probably paper leaks, something that we're living through right now, the NEET examination and protests around it. So this is something where, of course, the government needs to listen and understand what's exactly happening, what's exactly going on wrong, I would say, when there are multiple paper leaks or multiple kind of dubious measures. However, I feel when it comes to unemployment, this is just a part of the problem. This is more of a narrower problem, because it's mostly concentrated in these high stakes competitive exams. But I believe the much larger problem of this 44% unemployability gap is not really cheating, in my opinion. I believe it's curriculum. Multiple reports, multiple economists, even policymakers for that matter, have highlighted this, that the curriculum or the way of teaching in schools from, the middle school and high school education itself, or hands-on training, is very, very insufficient when it comes to graduates getting or being even employable for that matter, in this country.
Right.
So this is something that I would like specifically to understand, that this this paper leaks or the dubious means, this is one part, but specifically the curriculum angle is something that needs to be delved deeper into at this point in time.
I think also when we talk about the curriculum, I think the way the curriculum is going, I think it's not looking at where industries stand or where
100%.
offices or like our work output is not exactly coherent with what's being taught. I think
100%.
we're more like the education system is very theory oriented, and of course that's necessary because it builds your foundation. But like once you leave the classroom, the theory doesn't sustain you in the real world.
Absolutely not. And I completely agree with you here. I'll take my subject, right, in economics itself. What you're taught, we've just spoken about the Phillips curve and how Japan is defying it, and there are multiple such theories, because economics, or every theory that we are taught in classrooms, is subject to certain assumptions that A, B, C will remain constant. But that is not how the real world works. This is where it's important to kind of inject this idea that in the real world these constraints will not be there, and that is how, when some of these constants, or in mathematical economics we have this very complicated equation in differential calculus, something that scares students. In differential equation you have a particular integral, and you have a complementary solution, and I always say the particular integral is basically your plan, the intertemporal equilibrium value. Complementary solution is when something unforeseen happens, and the deviation from the plan. That's all that is, that equation is. So that deviation from the plan is not really taught to us much. And that kind of confuses each and every one of us, how to go about when that deviation comes into the picture. It can be the COVID pandemic. It can be, the budget was announced just prior to the COVID pandemic, and then the pandemic hit, and then the government didn't know how to go about the process, because we were not taught, such instances. So this is something that, the education curriculum altogether in the Indian education system needs to relook into.
Now, Bidisha, the last question is by a viewer, and their username is Who Knows. They're asking, is India caught in a vicious cycle where unresolved land reforms hinder industrialization? Weak industrialization fails to absorb surplus agricultural labor, and the government, which can break this cycle, has been politically captured by land-owning groups which resist the reforms needed to break that cycle. In many developed economies, household wealth is held more through housing and financial assets and investment in stocks than through agricultural land. Would India's economic transformation require a similar shift away from treating agricultural land as a primary store of wealth? Could such a shift reduce land fragmentation and make land consolidation, agricultural investment, and industrial development easier, plus help corporate sectors through investment in stocks?
Now, land is something we've been discussing for multiple episodes in Bidishanomics, but I keep going back to answering questions associated with land, because I feel it's an imperative, extremely important reform, land and judicial reforms right now, before you ask for huge amounts of FDI to come into the picture, before you keep all these summits and G20 and all of these, bringing all the stakeholders, all the foreign investors together. You have to create the right kind of suitable environment for the foreign investors to invest. If you have an environment where business dispute cases, or a tiny business contract, or a land acquisition problem can take 10 to 20 years to be resolved, why would a foreign investor come in the first place? Starting with the data, the average Indian farm has been shrinking over the past 50 years, 2.28 hectares in 1970, and then it came down in 2015 to 1.08 hectares, and there's a more recent NABARD survey, by recent I mean 2021 survey, which is kind of putting the number at 0.74 hectares by 2021. Now, what is the reason for this shrinking sort of, Indian farm? So specifically, the first reason is the inheritance law. What happens is every family has, 3-4 kids, and the land kind of gets divided amongst all these children, and how that land is utilized, we don't know. So there are different records that come into the picture. The second is the state tenancy laws. Now, this goes back to like decades ago, where these tenants were kind of tortured by landowners, and the lands sort of at any point the land ownership could be taken away from them. So these state tenancy laws are now making leasing land out genuinely risky. Because certain landowners kind of fear that in the long term, if a tenant is holding a land for the long term, they can start claiming the land, that the land is theirs. So here, which is why owners simply don't lease out lands. Then comes, of course, this fragmentation kind of. There's a huge amount of land that sits underused, underutilized, and the fragmentation kind of compounds. It keeps increasing, and specifically the inheritance law and the state tenancy laws are kind of adding on to this compounding factor. Then to layer onto it even further is that India does not have a reliable system for proving who owns the land in the first place. Now, we've discussed this in previous episodes as well. Since a 1908 law, registering land sale only proves in India that only a transaction has happened. There's no government guaranteed, or the system that is referred to here in terms of owning a land is more of a presumptive system. It's not a conclusive system. For instance, in Australia or UK or Singapore, that the ownership is kind of certified. So tomorrow, if for instance there is any question on whether you own this particular land or not, the government can actually give you a guarantee for it. That doesn't happen in India. So here there's a huge confusion about who owns the land in the first place. You'll have to go back to decade-old records to find out who actually inherits the land. Now coming to a Niti Aayog research, there is a very, very detailed report and research done by Niti Aayog, which specifically points out or focuses on property disputes, and it says that property disputes make up 66% of all civil litigation in India, and the average land dispute takes about 20 years to resolve. Now, just think about what it can do, because sometimes, as we have discussed earlier, there are not just quantitative factors but qualitative factors that impact the decision making in an economy. For instance, inflation and inflation expectations, right? So here, specifically, I'll give you an example as well. Now, what happens is, let's first take from an agriculture or a farmer point of view. So no farmer kind of will confidently invest in a land that can be litigated away tomorrow. Then coming to a company, no company will confidently try and occupy a large parcel of land to kind of expand its factory or hire more workers or expand its planning as well in terms of its business, to be specific. And there's actually an example of it from Singur specifically, that this had happened. There was a friction behind famous industrial landowners. So unresolved land issues play a very, very big role when it comes to especially manufacturing, especially infrastructure, especially industrialization. So if we don't solve these basic things first, we cannot plan for a Viksit Bharat where there'll be huge amount of industrialization by 2047. Now coming to the political capture angle. Now this is some very interesting part of the question. The land ceiling laws from about 1960s, 1970s, they were kind of watered down. And this is something that I have recently spoken about in one of my pieces, a theory, a useful concept by Manker Olson, which is distributional coalitions. Basically what he said is that organized groups kind of resist reforms where they can visibly see risks, although the benefit of those reforms are kind of spread wide, and it's kind of widely distributed, and the economy would benefit as a whole. Now this has been happening with multiple economies, in the farm lobby in EU as well, with regards to the EU Mercosur trade agreement from the agricultural point of view, which is why within 11 days of implementation of the EU-Mercosur agreement, they have banned Brazilian beef. So there are multiple of these kinds, and specifically because of these distributional coalitions, there are landowning constituencies for exactly this kind of coalition, and they've been powerful, they've been persistent across the entire post-independent history. Here I would like to mention also there is an RBI's own household finance committee, which found that Indian households roughly hold 84% of their wealth in real estate and physical assets, 11% they hold in gold, and just 5% in financial assets. And there's also another report by UBS, a global wealth report that was published just a few weeks ago, that confirms that this hasn't really meaningfully changed, but financial assets are only 25.8% of Indian household wealth, which is among the lowest in the 56 countries. I'll give you a comparative kind of analysis here. We can compare that to 79% in the United States. There is over 80% in Sweden and Israel, and even China. Even if we keep aside these countries, China, which is in some way or the other still a developing or an emerging economy, there the percentage is 52%. So India is kind of behind, households kind of shifting towards more financial assets rather than land, for that matter. Now in countries like the US or UK, as we can see that the household wealth over time shifted towards housing and financial assets, mostly as a consequence of industrialization. I would not say that this movement towards different kind of investment in financial assets was the cause of industrialization, but more as a result of the industrialization. So as an economy kind of grows and moves towards industrialization, agriculture's share kind of dwindles, and hence the incentive to own land or occupy land rather than use it kind of also diminishes. So this is exactly the reason why pushing people to first kind of move to owning different equities or financial assets and then industrialization will happen is not a process that India should follow. Rather it should be the other way around, because the minute industrialization will happen, the minute land reforms, the minute these dispute issues are resolved, the judicial reforms are also, especially business dispute cases, are also resolved, then automatically the owning of certain assets or Indian household assets will move from land to sort of financial or equities or stocks, for that matter. So the solution here specifically would be that it's not just about fixing what land itself can do. We have spoken about this conclusive system. We need to move from the presumptive to the conclusive system. There has been a program, in fact, in place since 2008 called DILRMP that has been attempting this with limited success, of course, and reforms leasing laws, something that we've spoken about. Because of the state tenancy laws, the leasing laws have to be reformed, have to be looked into, so that the landowners can lease out the lands easily without fearing that the tenants will kind of, because they're holding on to a land for long term, they will kind of capture that land and say that they own this land. So for that, a conclusive titling is very important, and at the same time, these leasing laws need to be reformed.
Of course. Bidisha, that brings us to the end of our episode today. Thank you so much for taking questions from our members who send us questions that always keep us sharp, always keep us curious. And like always, I thank Bidisha for this. Economics was always a very scary subject for me. I rejected it in my 11th grade, but she has made me think and actually find it less intimidating. Thank you so much for being with us. We'll be back again next week with another episode of Bidishanomics.